Hey guys, it's Matt Duckworth with Deal Camp, and today we're talking about the reasons why people lose money whenever they do an acquisition, especially leverage buyouts. So what we're going to talk about today is number one of the three main ways that people lose money whenever they do an acquisition. This is not the only reasons. There's books written about this stuff that you can check out, and we can maybe find a way to leave that in the show notes. But there's the top three ways are, number one, too much leverage. This has caused a lot of people to just blow up. And people pay too much money for an acquisition. This is one of the things that's happened with SaaS right now that has just killed a lot of, especially venture capital funds. And then you buy a business in a bad industry. And we'll talk about this in 2 and 3 in another video. But today we're talking about leverage and how leverage is a thing that blows people up. It causes people to lose money. And what I want to do today is show you how to kind of structure your deals so that you avoid some of these common mistakes using leverage, because there's a way to do this, to use leverage in a smart way that gives you lots of options and doesn't cramp your style. It doesn't put you in a position where it's a lot easier for you to lose money. So I'll just quickly kind of go through this. There's two main ways that leverage gets people. So they try to underwrite a deal using too tight of this term called a debt service coverage ratio. So DSCR means debt service coverage ratio. And what is that? Well, just to give you an idea of what that is, so if you had a business that was doing $1 million a year in cash flow, banks will require a 1.2 times, it's different for different banks, but generally a 1.2 times debt service coverage ratio. And all that means is free cash flow over debt service should equal 1.2 or higher. So 1.2 times would make that debt service payment $833,000 and change. So that's what a debt service coverage ratio is. And why is that important? Well, so there's all these different reasons why people need what I call wiggle room. Wiggle room. And whenever you have $1 million in EBITDA, what does that mean? Think about that. Like an average net income margin for a business in the United States, it's about 10% net. Okay, so if a business was throwing off $1 million in free cash flow and it had a 10% free cash flow margin, that would mean that the business's revenue would be about $10 million. Well, here's the problem. So million bucks a year in cash flow minus this debt service payment is about $167,000 a year in free cash flow to equity. This is basically what's left over for you. Well, if a business is doing $10 million in revenue, throwing off $1 million in cash flow, how easy do you think it is for that business to hit a little bump in the road and suck up all $167,000 and more to basically put you in a position where you can't pay the full amount on the note? It's pretty dang easy. So if you don't have a great plan to grow cash flow, you're just hoping this business is going to plod along, and you're underwriting this thing with your bank at a 1.2 times debt service coverage ratio, you ain't got no wiggle room, brother. So what we want is to create a safe target. So we typically will do like 1.7 times debt service coverage ratios or better. I really like to do 2 times. Like I've already blown myself up and learned all this stuff. So I am pretty conservative using debt. So what that means is, to give us the wiggle room that we need on that business doing $1 million in free cash flow, At a 1.75 times debt service coverage ratio, if you're following me, that means that we've got about $430,000 in cash flow available for you. We can put that money in our pocket. So 430K about. Somebody out there watching the video can do the true math. This is our cash flow. So in this scenario, you've got almost 3 times the amount of cash flow available to do stuff with. And so here's what happens whenever you go out and buy a business. So you may get a blip in the economy, right? Right now we're living in a really weird time with inflation and interest rates are going up. And like there's just been all these people who have been out of the workforce or maybe coming in. So like it's just, who knows what's going to happen. So the economy could be a problem. Staffing. Guess what happens if you find out, hey, I'm a bad manager, I need some help. Maybe it's I have really low attention to detail, I don't like doing paperwork, I need an administrative assistant, or I'm going to drive everybody crazy and a bunch of stuff's not going to get done. So if you need to hire an administrative assistant, you might knock off, after all the benefits and everything that you're going to have to pay, you might knock off $67,000 off of this number. Now you got $100,000 free cash flow that's going to you if you underwrite this thing too tight, right? So staffing is another issue. Maybe it's, I need some marketing help. Maybe I need to invest in something due to an industry change. So a lot of times policy changes in industries. Maybe you find out about something, you're buying a business that you've not been heavily involved in and you don't know about all the regulations. And so to be able to have somebody who's really well educated about that, you might have to hire a consultant. And very specialized consultants are typically not cheap. So that's another reason why people get pinched. And then the last reason is, say you bought a manufacturing firm and you assume that, that's the cash flow, and a piece of equipment fails. You got to get a new piece of equipment. Well, you may be in trouble here because you really don't have any wiggle room to get a bank to lend you money for that piece of equipment if it's really big. And you may not have a ton of cash available, and so you just may be stuck. And if it's a key piece of equipment, you may not have any options. So that can be a major issue. And there's lots of other reasons right here where you'd want to have, you may run up against something that causes you to eat into all or even more of this, say, 167,000 in this example. And so in this example, can you afford an admin? Yeah. Can you afford some marketing help? Yeah. Could you drop $50,000 on a consultant? Yeah. Could you buy a piece of equipment? Yeah, you could get a bank to loan you some more money because you've got more room here, because really they're looking for this 1.2 times debt service coverage ratio. If you're here, you still got a way out. So it gives you this ability to continue to negotiate and get the money that you need for your business. So that's number one reason out of the reasons why people blow themselves up with leverage. And so the second piece of this is too much debt as a percentage of the worst case value of the business. So let's say that you had a business that was worth $1 million. This is the example. And this is in a worst case scenario. Maybe the business, you're buying it for $2 million, right? And but it's like a SaaS company. This has happened in the last 8 months. So it's like August 2022 right now at the time of this video. And in January, the average SaaS multiple on annual recurring revenue was like 15, 16 times. So take the annual recurring revenue, multiply it by 15, 16 times, and that's the value of the business on average for that industry. Now, because everything has come down and the market's kind of crashed, I think the average SaaS multiple is closer to like 7, 8 times. It may have even gone lower than that. So it basically got cut in half. Okay, so let's say that you had bought a SaaS business at $2 million, and in this worst case scenario, multiples come down to $1 million, and you had borrowed 75% of the value of that company whenever it was worth 2 million, and now it's worth $1 million. So you're underwater by $500,000. So you've got to grow this business in value by $500,000 to know that you're just going to be able to get out without having to basically pay off this net here, this $500,000 that's at risk. And so this is another thing that people don't pay attention to whenever they're buying a company, especially like in technology. If you're using leverage, buying new economy sort of businesses like websites, e-commerce stores, for example, SaaS businesses and software companies like that, that's a pretty new world. There's not a lot of case studies on how to handle all the risk, and so people do make a lot of mistakes when these new economy type businesses. That's why, like, what we do is we're just interested in really boring businesses. Businesses where, in a worst case scenario, we can sell off some assets or something, or we know that there's a ready buyer somewhere and we can get out of the debt. Even if we've used 100% debt financing to buy the business, it's still in a position where we can get out and not lose money, because that's number one rule for us. So those are the two major ways that leverage will get you. And in the next video series, we'll talk about paying too much in that industry. Hope that helps.